Hello, Jason Bates here, owner of Electrum Financial, located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. If you like the lowest rates at the lowest cost, then allow me to put my 30 years of experience to work for you. You've got nothing to lose. Here is this week's mortgage market at a glance. When it comes to the mortgage and housing markets, there's been no shortage of gloomy news for months. This generally involves slumping sales, lower prices, and higher rates, all of which are interconnected to some extent. Home prices surged post-COVID as demand greatly outpaced supply, and low rates increased buying power. High home prices then contributed significantly to high inflation numbers. High inflation is the single biggest reason for the fastest rate spike since the 1980s. Newly high rates made buyers increasingly reluctant to shop for homes and homeowners increasingly reluctant to give up the super low rates obtained over the previous 2 years. In January, it looked like there might be some relief for high rates and slumping sales. But then February happened. A series of economic reports caused an immediate renewal of fear over the inflation outlook. And again, inflation is the key input for rates right now, although I'm sticking to my claim that the jobs numbers and wage growth will be the headlines for 2023. The most recent addition to the inflation narrative was this week's PCE price index, which is frequently referred to as the Federal Reserve's favorite inflation indicator. PCE doesn't usually impact markets too much. That honor is reserved for CPI, which came out earlier in the month. But if PCE delivers a different message, it can get the market's attention. That's what happened this week. By Thursday, rates were showing signs that they might be willing to calm down after several weeks of spent surging quickly higher. Then Friday's PCE inflation numbers came out hotter than expected, with the closely watched core number, which excludes more volatile food and energy, rising back to the highest month-over-month levels in decades. This paints a very different picture than the CPI version of the data, which had generally been trending lower for more than a year. Whether core inflation is 0.4 or 0.6 in a month-over-month terms, that implies a range of 4.8 to 7.2% annually. That's catastrophically high in either case, considering the Fed's target is 2%. The following chart shows the market's expectations for the Fed's funds rate at the various points in the future. Notice that December is now seen remaining very close to the high rates achieved in June and September, which is the narrow range, and that the outlook has moved higher across the board. The Fed funds rate doesn't dictate mortgage rates, but the long-run rate outlook lines up very well with mortgage rate momentum, much like 10-year Treasury yields. The following chart overlays 10-year yields on the December Fed funds rate expectations to show the correlation. In other words, higher inflation and stronger economic data cause traders to bet on more Fed rate hikes in the future. Longer-term rates like 10-year Treasuries and mortgage rates moved up in response to the shift in the outlook. The silver lining here is that mortgage rates were more cautious at the end of January than they were in August. This time around, the rate spike, while no doubt unpleasant, hasn't had the same sort of frantic quality. It has occurred in measured steps, and each step has come in response to economic data that legitimately makes a case for higher rates. This means that rates should remain receptive when the data eventually shifts. When that happens, there are signs that the housing market will also be receptive. To be sure, outright sales numbers have plummeted in the existing home market, but the drop has been very different from the last comparable drop seen during the financial crisis. Back then, mortgage market was systematically imploding and there was an unprecedented glut of inventory. The opposite is true these days. Granted, mortgage companies have certainly been contracting due to the rapid decline in loan origination, but from an investor standpoint, present day lending is infinitely more sound and sustainable than it was before the financial crisis. The inventory contrast is even clearer. Simply put, there isn't any. The takeaway is that a sensible moderation in interest rates can pave the way for an uptick in inventory, affordability, and demand. That's a fairly ideal recipe for stronger sales. The only question is how long it takes for that data to show up. So there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you. If you're looking to purchase or refinance a home in Arizona, I'd like to meet you. And I'd like to be your broker of choice. So until next time, take care and stay safe.